ये लंबी रेस है, and for this लंबी रेस foundation has to be robust. Just gunning for growth for the sake of growth, you need to have some temperature reading of the environment. Use the valuations and use the volatility to spread out your investment. You know, you and I as employees maybe have an annual appraisal.
Yeah.
Well, guess what? Politicians have 5-year appraisal cycles because they got to get re-elected.
Absolutely.
There are always unknowns and unknowables. There is never a market I have experienced in 30 years where everything is known. In fact, most cases where people think everything is known is a very dangerous market.
Hi friends, so we are at the beautiful UTI head office in Mumbai, and with me is Vetri Subramaniam, CIO of UTI Mutual Fund. Welcome, Vetri. Actually, you should say welcome because I'm in your office.
You're most welcome to be here, and I'm delighted we can have this conversation, and I like the setting since it's nice, friendly, and hopefully that can be the tone with which we are able to communicate.
So, what we do in this podcast series, Vetri, is we don't try to bring in too much jargon or heavy stuff. We try to keep it light so that our viewers, listeners can kind of absorb it well. And the topics for discussions are somewhat topics of the day.
Of course.
So we are not kind of talking about some very long, dumb esoteric stuff. Although I would like to pick your brain on some of these. I remember 1 year back we were having this discussion on Twitter, and in general, market, the mood was much bullish then, and we were talking about how market will pan out. The mood right now is somewhat sober, if I can use the word.
Right.
There has been some correction, especially if you see over the last 6 months. The previous 3 years were very good from an equity standpoint. But if you look at last year, at least the headline indices, they have barely given positive return. Mid-cap, small-cap indices have given double-digit returns, but that again was kind of front-loaded in the first half.
Correct.
Second half has been bad. And the first month of this year also has kind of been a little volatile. We are recording this on 6th of February. So the big point which I want to kind of discuss with you is what should investors do, except obviously we also kind of keep on educating all the investors that existing SIPs you must not touch. They should continue wherever, we'll talk about some of the sectors, etc., where we see more value. If possible, we can top up from there. But from a slightly more macro standpoint, that most of the investors who came in the last 3-4 years have seen very good returns. Some of those returns have gone away also. In this setup, how should investors kind of look at the market?
Sure. I think that's a good place to start with, and it's always useful to sort of keep a little bit of context when you think about this. When you look at very, very long-term trends, going back 20 years, and then you can slice and dice it and look at rolling 5 years, rolling 10 years. I would say, sort of the average return in equities works out to about 12 to 14% is what I would say.
Yeah.
And when we say equities, we are effectively referring to, the Nifty 50, which is what we have the best data for. So in a sense, it is a large cap proxy.
Yeah.
Right? Now, and since you particularly mentioned that people got great returns over the last 3 years, very true. But important to remember that what is the source of those returns? The source of those returns are earnings. Earnings cannot compound at a rate very dramatically different from these kind of numbers. And therefore, the one point that I would like to make is in the long term, equity returns are a slave to earnings, and these two tend to sort of be correlated, but they do not match point to point. There can be a period where earnings can grow faster. There can be a period where the two can diverge and choose to go in opposite directions, both ways. Sometimes the stock prices do better, sometimes earnings don't do as well, and equally the opposite can also happen. So that's the perspective with which to think about it. And even a few months ago, I said the same thing when I said that in effect, the market has already borrowed returns from the future in terms of where it has reached, simply because it has elevated the valuations a bit too much.
Okay.
So when I talk about that average return of 12%, it's an average.
Yeah.
Right? But around that average, you will find that there are negative returns over 3 years and 5 years, leave alone 1 year.
Okay.
And there are also hugely positive returns. Those hugely positive returns tend to be correlated with starting valuations which are cheap. The negative valuations tend to be correlated primarily by valuations which at the starting point are more expensive. So that's the template to bring. When you think about it from that template, we were in a market which was quite rich in most of 2024. And I'd say if anything, I was early to this in terms of being worried about the market. Even going into 2024, market did spectacularly well through the first 9 months. But I think at some point, the reality of valuations being high has started to catch up with the market. You've seen a sell-off. So what should investors do now that there is a sell-off? I would sort of boil it down to 2-3 things. First, when we look at the large cap space, we run an internal equity valuation indicator. Now, the good news is that this has retreated from being expensive into what we call fair value zone.
Okay.
So, if the question is this a safe time for me to enter the ocean? The answer is yes. Okay. Because now you are back in the fair value zone.
This is only large caps?
This is only large caps because we are only tracking the Nifty 50 for which there is good historical data available. So from a large cap perspective, actually, we think the market is back in what we would consider fair value territory. It is not cheap, but it is back in fair value territory. Therefore, there is no reason for people to shy away from entering the market. You could enter. You may want to continue to stagger your investments a little, but in large caps, we are quite comfortable. However, when I look at the aggregate market, the broader market, right? So you've got large caps, you've got mid caps, you've got small caps. At an aggregate level, our comfort in small and mid caps is still very limited.
Even after this correction?
Even after this correction. Because the aggregate valuations in these two parts of the market still appear very, very elevated. We don't have the kind of data going back 20 years to call it the way we do it in the large caps, but there's enough in the data telling us that, these are still expensive. So into the sell-off, there are some opportunities which have started to become visible, but not enough for me to say, okay, mid caps are attractive or small caps are attractive. Yeah, we can look at it and find some stocks, but it's still very hard over there to really call the class of companies as an aggregate. And because as mutual funds, we run mid cap funds and small cap funds, we are not calling for investment in those two. We think you're better off, focusing on that large cap space. So that's point number one. I would still say, spread out your investments slightly even in this environment, because unfortunately we are also experiencing other reasons for volatility.
We'll talk about that.
Yeah.
We'll talk about
so I would still say, sort of stagger it. And one final recommendation I'll make, Raut, because this is what we've been telling everybody, is look at the hybrid category. Why look at the hybrid category? One, it's not 100% equity. Equities have entered fair value.
Yeah.
So when you go into the hybrid, you're getting some equity, but you're not getting 100% equity.
Yeah.
Not a bad thing to do in this market environment, which is not yet cheap. B, you're getting allocation to fixed income, which has actually got a pretty decent carry because, the portfolio return on fixed income pre-expenses is 7% plus.
Yeah, 7 to 8.
We are looking at inflation, worst case, sort of a 4.5%, 5%. You got a 2% carry. It's coming in this nice hybrid structure where taxation is slightly more advantageous. So really, if people want to invest lump sum, we've been saying look at hybrids, including equity biased ones as well. And other than that, look at the large caps as a place where you might want to stagger. And of course, I'm not going to say this, but continue the SIP, because the whole purpose of the SIP is you keep doing SIPs over a very long period of time. You'll effectively pick up the average valuation over long terms.
So, okay, I understood the mental model you are working with, that you favor large caps over others. And let me talk a little bit about the risks, at least the way I personally see. The biggest elephant in the room is the elephant of USA, right? And Mr. Trump has taken office formally now. And to say that the first month has been dramatic would be an understatement, right? Whether it is on immigration front or whether it's on government efficiency, spending cuts front, whether it is on tariffs, right? We saw actions against Canada, Mexico, and they've kind of neutralized again. The overall geopolitical setting, which then reflects in the economic/market setting, is kind of extremely unpredictable, right? And, obviously we know that when markets are unpredictable, it's better to be with large caps. But how do you see that juxtaposing with somewhat of a shakiness that we are seeing in Indian equity markets? And I will also want to, you to comment upon how FIs are taking money away from India.
Sure. So, this has been one of my learnings over a period of time, investing for almost 30 years now professionally, which is that you have to recognize that some things are outside your control. You have to recognize that some things are beyond your ability to discern. They are beyond your ability to understand how they will play out, right? Okay. If that be the case, focus on what is within your control. What is within your control is your behavior. What is within your control is the market reached a level where I'm getting comfort from the valuations, the way I look at them. Is my asset allocation aligned with where my financial goals are? So I would say control for that rather than think about these things which are complete unknowns. Okay. So do I really know what will happen in terms of, President Trump and tariffs? The answer is no. But the answer is even he might not know because, he flips his mind so easily, it's very hard to figure out. Look at it this way. I think from a valuation standpoint, as I said, in India, at least you've corrected back to slightly more reasonable levels from a large cap perspective. But you need to have some temperature reading of the environment. The temperature reading of the environment is that this is not a great global growth environment, right? Most large economies are struggling. Yeah. The only exception is the US, which is actually doing very well relative to its own trend, and India, which is still doing reasonably well. Whether it's China, Japan, Europe, etc., all have their own share of problems. So, question you're asking yourself, okay, is global growth outlook great? The answer is it's not. B, is somebody stirring the pot and making a mess out of it? The answer is yes, because that's exactly what President Trump's actions are doing. And then finally, what does this do to entrepreneurs? See, even before you think about what should I do as an investor, at some level, every investor is an entrepreneur. Yeah. Right? Now, my question to you is, which entrepreneur in the world is going to feel very bold about making large investments in the current environment when they look around and say, hey, there's this whole wave of uncertainty that is spreading and I don't know how this cookie is going to crumble. I don't know how this, ship is going to navigate the waters. So I see the world in a little bit of a risk-off mode simply because of the uncertainty. And to that extent, therefore, I would say, you need to be cautious, and that fits into my thought process of saying I can't figure out what the hell will happen over there, but use the valuations and use the volatility to spread out your investments, because that is what is within your control based on where your financial goals are. But that would be my big message. And this has always been true, Rohit. This is not just today. I mean, today the uncertainty is President Trump. 2 years ago, the uncertainty may have been something else. What will the Fed do? 4 years ago, back was COVID. So there are always unknowns and unknowables. There is never a market I have experienced in 30 years where everything is known. In fact, most cases where people think everything is known is a very dangerous market. That is actually the case. When there is a high level of uncertainty, which is reflected in valuations, actually the margin of safety is in your favor, right? Beyond there as yet, when I look at the aggregate market, but the opportunities which are visible, you should use. So that's the way I would.
So I'll pick up something that you just said is maybe it's slightly looking like a risk-off kind of market. Is that the reason why kind of FIs have been selling so aggressively, or is it because US is doing so well, so let's take the money to US?
When I was growing up in school, there used to be these very famous films division, films used to get released and they would all have this concept of unity in diversity.
Yeah.
Right? And anybody who lives in India knows it's a very diverse country. Yeah. My only recommendation would be, even when you think about FPIs, please remember this is a very diverse set of investors. Okay, you can't just call them FPI and presume all of them have woken up and are behaving on the same template, right? There are hedge funds, there are long-only funds, there are long-only funds who've been investing in India and their entire careers have been built on investing in India for 30 years now, right? I know them. These guys are, girls are all friends.
Yeah.
So it's not that there is one unanimous you will find. I will actually go back and point to only one thing. Most traditional long-only investors in India, in some senses, are facing the same issue that what I was espousing, that, hey, what the hell happened to valuations in India? How come it's sort of moved to this extremely elevated level? The second challenge, which I think is what has created pressure on FII outflows or FPI outflows from India, the two elements to it. One, suddenly the US bond market has become a valid investment option in anybody's portfolio.
4.5% dollar return.
Absolutely, right? So now why are you going and taking risks far away from home when the bonds are giving you 4.5? I think this is having some impact on the asset allocator mindset of where to allocate. If you come one level down and then say, okay, this is causing money to, think about bonds in the long term. The second one, which is causing people to think again, is when you look at equities and you stack up equity markets on the richness of their valuation from top to bottom. Number one is US, number two is India. Well, the challenge is the number one market is 55 to 60% of benchmark. The number two market is 3% of benchmark. Oh, who wants to take career risk on 55% of benchmark? So they are taking 3% and saying, let's reduce the allocation. At least here it's a rich market. My view on FPIs is that given what has happened in terms of the correction, given what has happened in terms of the slide in the currency, honestly, large caps to my mind for foreigners is a valuation trade. When these valuations get comfortable, I think they can surprise you in terms of their willingness to
letting
start
money
to
back.
put money. Exactly. Because they have deep knowledge of these companies and markets.
Also, the kind of money which they'll invest, only these companies can absorb.
Absolutely.
Small companies cannot absorb the big flow which they bring.
So hard to predict when it turns,
So that's okay.
but it will come at some point when the valuations and currency.
No, so I think, and this, kind of we have discussed in the past also that investors, while making their decision, if one variable they want to bring in is the margin of safety, if it's looking slightly better, personally you can be slightly more aggressive if it is. Otherwise, for like most of the salaried people like me, I have money every month. I have I have to invest somewhere, right? So I think this is a point well made. But my second part of what investor or how investors should think about is somewhat linked to what happened in the last 1.5 years, which is this huge influx of money which came in sector-based or thematic funds, right? Whether it is PSU, whether it is defense, and some of the others also, which at some point in time they were showing great returns. I remember seeing defense funds giving up to almost 100% returns also. And a lot of that has got shaven off brutally, if I may say so, over the last 3 or 4 months. And this we have seen, you've seen it for 30 years, I've seen it for 15 years, that sectoral funds, you need to be really smart when to get in, get out. Almost at your personal portfolio level, you act as a fund manager when you are betting on a sector. So two things. One is going into the current year, which are the sectors you think are likely to do well, and does this big tax relief which has come in the budget, do you think it's a major factor, or doesn't play? It is more a sentiment change and not so much a real factor. So these two things. First, maybe sectors do you think should do well?
So sector is actually quite difficult. And also easy at one level. Easy because honestly the only one sector I've felt very strongly about, not today but going back the last 6 to 8 months, has been banking and financial services.
It's not done well.
It's not done well. The valuations are still largely reasonable. There are pockets which are rich, but broadly I would think lending institutions are quite fairly valued. There are concerns. But I love it when there are concerns, because that's when the valuations start to reflect those concerns and it creates an opportunity for you. I think banking and financial services in general is still a comfortable growth industry in India. There is still a need for credit itself to grow faster, leave alone how the rest of the bouquet might grow. So banking and finance has really been the one sector that I would say I am still very positive about, have been for quite a few months, remain quite positively inclined that that's an area where I think you're actually getting a great combination of reasonable growth prospects combined with starting valuations which are attractive. And a lot of investment problems get resolved when starting valuations are reasonable. So that's the one sector I really...
Going back to a margin of safety.
Exactly, yeah. Outside of that, I would say it's more at a stock-specific level. For 2023, we were very, very positive on pharma healthcare. It did brilliantly well in 2024. But, I think at best now it's maybe a relative play that it doesn't capture too much downside relative to the market, but I'm not sure it's an absolute return play anymore. So I'll just stick to that one as something that we are, positive about.
Yeah.
From
And about consumption, yeah.
just one from a theme perspective, nothing to do with what can happen in the next 6 to 12 months. But I do think India is at a point where, we were talking about this earlier. You are seeing some businesses which are sort of more innovation led, not necessarily that they are hardcore R&D businesses, but they are using some level of innovation. They are disrupting existing business models. So innovation as a theme is something we like. It's a very volatile theme. But I think if you're willing to look 3 to 5 years, this can be something which could do well. But again, play it out steadily over time because it is a very volatile thing.
No, so I mean, I don't know how is there an escape for both me as a retail investor and for you as a ultra experienced fund manager, because all the new companies which are going to get listed are from this sector.
Yeah,
See,
but that is an opportunity.
Yeah, that's what.
Right? Because most other businesses, Rohit, including what I said first, which is banking and finance. See, in most of these businesses, we are attuned to thinking in terms of, okay, if nominal GDP is 10%, credit grows 12%, they will use so much capital. So it's very linear equations.
Yeah.
The innovation theme has many companies which are non-linear in terms of their outcomes.
Correct.
Yes, what they also have is high probability of will it be successful, high probability it may be unsuccessful.
Yeah.
But that non-linearity is an attractive proposition, and which is why we think the volatility is something, if you're able to navigate, that could be a good theme to look at. And going to your second part of the question, which is on consumption, honestly, I think there's a bit of a false binary. Right? This investment or consumption is a false binary. Yes, there was a period where government was increasing its capex, whatever that helped certain investment parts of the economy. The right way to think about what government did in this budget is that the government has taken a call to implement what I call a supply side policy initiative, which is to say, instead of me taking 1 lakh crores from Rohit, Vetri and everybody else around and then deciding where to spend it, let me not take it. I will leave 1 lakh crores with them.
You decide where to.
Let them figure out what they want to do with it.
Yeah.
Rohit's interest might be aligned with buying a house.
Yeah.
My interest may be aligned with saving that money. Somebody else's interest might be that, okay, great, I've got this debt I want to pay down, let me pay it down. Somebody else's interest might be, let me spend that money. So it's really a supply side initiative to say that instead of Sarkar being my bap and deciding where to put the money to work in capex or this or that, let's leave it with the people, because people are best placed to take the best return on investment for the money which is left with them in practice. So it's a supply side initiative in that sense. I think it's a very powerful long-term, sort of thing that they have done. It will have a positive impact. But to look at it merely as a consumption boost is slightly misplaced, because as I said, people have optionality of where they will direct it. Secondly, the actual spending on consumption is a function of marginal propensity to consume. Additional money flowing into my pocket doesn't necessarily incentivize me to consume, but there could be people at lower levels of income where that additional income immediately becomes consumption oriented. But one final point, not just because of this budget, which does give households some flexibility, but also because if you look at the last 12 to 18 months, there's a host of state governments who have ramped out all kinds of schemes which are effectively in the nature of fiscal transfers, putting more money into the
cash
households through cash transfers. Because of all of this, along with the tax cut, I do think there will be some improvement in consumption trends, which were actually very weak in 24 and 25 financial years.
Yeah.
So I think there will be some uptick, but don't look at it merely from the point of view of, chalo, now I should be buying consumption. I think that's the wrong thought process based on what the government.
Actually, a very nice point you made in your previous argument, and I'm now trying to correlate the two, which is consumption along with disruption. And if you look at results published by all listed companies and some of the platform companies, distribution companies, your manufacturers are not growing at that pace, right? Overall, whether it is volume growth, earning growth, revenue growth, it's not barely double digits, single digit for most. Whereas your platform companies who are actually distributors distributing the same product are growing at 50, 60, 100% and so on. So in some sense, that disruption is for us to see right in front of our eyes.
Absolutely.
I might be a great soap company with a pan India, maybe a global brand. I'm growing at 6%, but this guy who's distributing me is growing at 100%.
Yeah. Because those disrupting businesses are not limited by the fact that, see, when you say GDP is growing at 10%, what does it mean? It means the country's income is growing at 10%. There are many businesses whose one way or the other, it's not causality, but their growth is eventually somewhere correlated to how our income is growing.
Yeah.
But the businesses who are disrupting something, they are most only gaining market share, and their disruption is creating new consumption patterns, it's creating new buyer behavior, it's creating new supplier response, and their growth accelerates. Total economic consumption will still be limited by the 10% number. But those innovative companies which are doing it differently, just end up growing so much more.
Don't talk about new consumption patterns. I'm troubled by my food delivery bills now. So I have to uninstall some apps, I think. So great, fine. So we covered, how investors should think about the market and which sectors do you think?
Just one thing I wanted to add, because you asked about, how investors should think about the market. And I'm hearing, just sort of sharing my own experience of having seen markets behave over, many cycles. I think one of the things I would caution people, and this is not necessarily people, just mutual funds, those who are doing stocks as well. A stock does not become cheap just because it dropped 30% or 40%.
Yeah.
Right. If I look at the Nifty 500, today there are close to 40% of the stocks in the Nifty 500 which are down more than 30% from their 52-week high. And then almost 60% of the stocks are down more than 20% from their 52-week high. So there's a lot of price damage which has happened. But please never interpret price damage as equal to valuation correction. These two are different. And I think the thing which I have seen people lose very serious money, particularly in 2000, 2001, is people just going in to buy the dip because the stock has dropped.
Yeah.
I would say this is a time to go back and check. Does your company have cash flow, return on capital? Does it have a market which is growing? Does it have the ability to do it? Or is it all just a narrative? Because, eventually what I have figured out over many years of investing is what is intrinsic to a company is its ability to manage cash flow and return on capital. Then it figures out what's happening in the economy, in the environment, and then, pyramids its growth through that. But if your company is only narrative, and these two fundamental pillars are missing, then you are barking up the wrong tree by saying, 30% gir gaya, so it has become cheap. And today you are in a market where suddenly, as I said, 40% of the stocks have fallen 30% or more.
Yeah.
I just want to tell people that does not make stocks cheap. You need to go back and check, does the company have the ability to power through?
Yeah.
Does the company have the ability to continue growing when it has a poor return on capital and no intrinsic cash flow? Because a company which does not have cash flow and does not have high return on capital is dependent on either the bankers or equity markets to keep funding its growth plans.
Yeah.
That becomes dangerous when the music slows, forget stops.
Yeah.
So, that's something I'd want to share because people look at it.
This is a stupid refresh.
Stock is down.
Refresher you just gave me. My first year after job, I started my career with CRISIL and, credit analysis. This was the first thing which was taught to us कि cash flows तो तुम बनाना सीख लो, बाकी सब ठीक है. So, again, I just hope some of our company CFOs are also thinking about it. So, on our last track, Vetri, you all, kind enough to give us so much time, is what is ailing the economy, right? So, we spoke about that India is a bright spot in the global context, which is fine, right? Largely, if you kind of remove the IT, and now why should I say IT? Actually, our overall services export, because non-IT also is quite large, actually maybe larger than IT. If you remove that which is affected by global markets, India still is a largely domestic consumption investment-led economy, right? And our trend rate of growth, we thought it will be 8 to 10%. It is kind of slipping now 7, now 6. Why are we not able to grow faster? What is it that we need to do? Government has started so many policies, PLI, this, that, and the other. So much investment has happened in roads, rails, everywhere, airports. Why are we not able to break this 6, 7% and grow faster?
Well, the only answer I have to that is I think 8% has always been only the aspirational number. If you look at the capability of the economy, It is 6.5%. No, in a great year it can be slightly above 7. In a bad year it could be slightly below 6. But 6.5% plus or minus 100 basis points is how I think about the capability of the country in terms of growth rates. And at that level, we can manage it domestically, which is the other important point. I think that's actually a pretty great outcome. Look, is it, stories like Korea, Japan, or even, China are exceptions to the rule in terms of those countries being able to grow at 8 to 10% for multiple decades. Right? I mean, China did it for almost 2 decades at 10%. But, those were very different economies. Our economy is very different from that point of view. And I'm not sure that we have the appetite for as dramatic, reforms and policies the way other countries have done. And this is not to do with just the fact that one country over there we are talking about is not a democracy and we are a democracy. But we are a democracy, and therefore in a democracy, the political economy is important. You and I as employees maybe have an annual appraisal.
Yeah.
Well, guess what? Politicians have 5-year appraisal cycles because they got to get re-elected.
Absolutely.
So they need to worry about how do you hold the political economy together. And when you look at it from that way, I think 6 to 7% is a good growth rate for India. Maybe short of our aspirational target. But to get to our aspirational target, we will really need the global economy to be supportive, both in terms of capital availability and in terms of global growth.
Yeah.
The only period where India actually sustained 8% growth for many years was, somewhere in the 2003-2010 period. But I would also submit that if anything, it was an experience that when you go for growth or allow growth to continue in such unabated fashion, you get a hangover, and we spent 6 to 7 years after 2010 cleaning up that mess. So I would not really aspire for that. I mean, or rather, I would aspire for that, but I don't think 6.5-7% is a bad growth number. I think 6.5% is a good number, and we need the global environment to be more supportive for exports to then add to the incrementality of our growth. One final point, Rohit, that I'll make. I think our government has been very focused on, the hopes and dreams of where we want to be, 20 years from now, 22 years from now, 2047, 100 years of independence, so on and so forth. But, to get there, one of the things you need to ensure is that the platform and macroeconomic stability is robust, right? So as much as we all talk about growth, I actually think the unstated accompanying priority number one of government is macroeconomic stability and prudence at all costs. That is reflected in the way how you have now guided the fiscal deficit back to 4.5% target next year, which is similar to your pre-pandemic trajectory. You're now saying, I want debt to GDP, which is 57-58%, to come down to 51%. So, ये लंबी रेस है. And for this lambi race, it is very important to make sure that the foundation has to be robust. Just gunning for growth for the sake of growth, we already know from our own past experience, it created a massive hangover.
Vetri, lambi race to hai, but a young populace like ours, are we patient enough to play for that lambi race?
Well, if you're asking me the question as an investor, I think you have to learn how to be patient. That's the fact of the matter. The equity returns justify your patience. That is the lesson from 20 years, 30 years of equity returns that we've seen. So therefore, I think as an investor, you have to be patient. B, I think the politicians also have to be patient because I think they understand better than anybody else that, and policymakers in general, not just politicians, but policymakers in general, that you need to hold the framework together. And that's why I'm saying the political economy becomes very, very important. If you're not able to hold the political economy together, don't just look at China and say, oh, wow, look at what they managed. Look around the entire globe and start putting a flag on every country which has been a complete disaster, nightmare, and gone into free fall.
Fire South American ultimately.
So please remember, you already are standing out vis-a-vis so many. Now, growing up, there was always this story about you go home and say, see, I got such a good rank. And your father or mother would look and say, Arey, but that guy got even the... So No, by that logic, if you want to keep looking at China and get disappointed, so be it. But I think we are doing pretty well. We should not beat ourselves up. And being prudent, there is value in that. We should not underplay. Just because as an equity investor, you are hoping to make 20% a year, let's not downplay the fact that our policymakers' prudence is putting us in a good place for that long race. It's a marathon. It's not a sprint.
Yeah, and okay, so if I go back to my point, which is being a young country, we have time to put.
Absolutely.
It's not that, the country is getting old and if I don't become rich this year, I am going to die. So I have time, the country has time.
Very true.
Yeah. Great. On that happy note, thank you so much. And it was lovely for you to invite us here and to your lovely office.
Delighted to have this conversation with you. Hopefully your listeners find it useful.
Yeah.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.